So hello everybody, my name is Radovan Vojtko and I'm CEO and Head of Research at Quantpedia. And I would like to welcome here Professor Michael Robbins from Columbia University. And we have two special guests here, Chen, Wang, and Kevin Zhao. I hope that I spelled your name fine. So Chen and Kevin are the winners of the Quantpedia Awards 2024. Firstly, I would really like to congratulate to you guys. Your paper was really amazing. And I'm really happy that I have Michael here with me, so we can ask you a few questions. And I mean, the first question is, of course, so tell us something about you.
All right, so maybe let me get started. Yeah, thank you very much. It's a great honor for both Kevin and I to have received this award. We can. Yeah, thank you now for picking us as the first. A little bit about myself. So my name is Chen Wang. I'm currently an assistant professor at the University of Notre Dame. So my research is mainly focused on asset pricing or empirical asset pricing. A lot of times it was a very specific behavioral finance. I will leave it to Kevin to introduce himself, and then we can talk more about the paper.
Hi, I'm Kevin Zhao. I'm a researcher at the Office of Financial Research. So I just want to give a brief disclaimer that everything that Chen and I say today is going to be our views alone and doesn't represent anything by the OFR. And so Chen and I, we actually met in grad school maybe like 5 or 6 years ago. And he graduated in 2020, I graduated in 2021. But since then, we've been working on a few projects, and our interest in like treasury markets specifically has really ramped up in the past year or so. And yeah, the paper that we submitted is the result of that.
Perfect, guys. Now, so my second, following question is, what was the main driver behind the idea? So first, I would like to tell the name of the paper, because we are talking about the paper. So the winner paper is Pre-Refunding Announcement Gains in US Treasurys. It was published in April 2024. And so as you guys mentioned, is about the treasuries. So it's not like the common topic of the research papers. Like 80% of the papers deals about equities, and from that the rest 20%, half of them deals about asset allocation. And then we go, and then there are the fixed income. So the fixed income is not such a popular topic. So I'm very happy that your paper won. So what was the driver behind that idea? Because that's the most interesting for me.
Yeah, of course. I think it's the driver are mainly twofold. And the first one is especially ever since COVID, we all know that the U.S. government is facing a lot of constraints on the fiscal capacity. So the government has responded to COVID very forcefully, but also that raised the debt level to a historical level. And also on the investor side, things are changing too. So like from the U.S. perspective, a lot of international investors are kind of scaling back their holdings of the treasuries. And also the Fed is very actively conducting its normalization of its balance sheet. That means the Fed is no longer requiring or actually selling a lot of the treasuries. So this is a market where kind of like at a very important inflection point. It's a point where maybe the treasury supply, or exactly how the treasury or the federal government decided to finance itself, has a much more meaningful impact on the market. So previously, if you think about what actually the treasury announces, it's normally like only maybe very specific traders on the treasury trading desk will only care about. But now, ever since what happened, especially in last August and last November, the treasury refunding announcement is carrying a lot of ways and attracting a lot of attention from the market, maybe more so than what a Treasury Department has wanted. So that kind of brings us to the starting point of the research. So a lot of research has been done on how official announcements of the various macro or monetary indicators impact the financial markets, but very little work, or almost no work, has been done on what the Treasury has announced and what that will have an impact on the treasuries market. So this is where we think we can make a potential contribution by essentially offer a first cut into this very specific aspect of the market to see what the data tell us and what kind of interesting asset pricing patterns that we can find in that specific aspect and specific part of the market. And also, I think it ought to mention, ever since COVID, essentially the government is playing a bigger and bigger role in terms of the asset prices. It's not only from the equities market, but I'm also we see a lot of that in the treasury and the bond market too. I think a very interesting interaction that we're currently exploring is kind of an interplay between the fiscal authority or the Treasury Department, also the monetary authority, the Federal Reserve, and how they collectively and interact with each other to impact the different asset markets. We look at the bond market, but also similar work can be done in the equities market or in the other markets too. Maybe Kevin have a few other things to say.
Yeah, so like one of the, I think, things that triggered us to really look into Treasury refunding announcements was that mostly just scouring the news and seeing this like increased attention that's been paid to these refunding announcements recently. And refunding announcements contain a lot of information on the future of how the US is going to fund itself, right? So like if we think of, for example, like a well-known pattern in the stock market, which is this pre-FOMC drift in equities markets, we're thinking that there might be a similar effect here on the bond market, where there's like a resolution of uncertainty in terms of treasuries that happens around this time. So that's how we kind of started thinking about this project.
Yeah, I really like your connection between, the drift during the Fed days, or Federal Open Market Committee days, and your paper, because when I wrote your paper, this was what I had in mind. So it would be great maybe if you summarize the main findings. So what do you find out, and what is the drift, and what is the effect, and how strong the drift is? Because it's really significant. So
we have a few slides. I think that can make this presentation much easier.
Yeah, so
because there's one very beautiful figure.
Yeah,
Kevin and I really wanted to show all of it.
Yeah.
Okay, wonderful. Yeah, so let me quickly summarize what we have found. I think literally everything is in this very striking and beautiful picture. So we're specifically looking at the Treasury refunding announcement. So this is basically a quarterly event. Every quarter, the Treasury, especially typically, it's in the first few days of the second month of a quarter. The Treasury will hold essentially a meeting or announcement to tell the world how much the Treasury decided to issue this quarter, specifically in the next few months. And we are specifically looking at the announcement on Monday of their essentially quarterly refunding announcements. And we call this day the Treasury refunding announcement, which is we take the shorthand of a TRA. So TRA is the day, especially around in the morning around 9 a.m. That's when the Treasury announces its borrowing needs. We look at the Treasury returns around the TRA, so the day before the TRA, the trading day before the TRA, and the trading day after TRA. So we call the trading day before TRA pre-TRA, and the one after post-TRA. And we start basically tracking the returns, or the cumulative returns, in this specific figure, the cumulative returns of 10-year treasuries, the actual 10-year treasury bond. And we start looking at its return on the day before the actual announcement. So we truncate the data until to the New York trading hours. That's where 90% of the trading happens. So we start around 7:30, and we start looking at what happened to the cumulative return of this 10-year bond on the day before the TRAs, compared with all the other days when it's not overlapped with any of the TRA days. So the blue line is basically, I think, the gist of this paper, or the gist of this the finding. So there's a very striking, essentially, a run-up in the Treasury returns or prices immediately after the morning trading hours. So the Treasury prices start going up, I think around 8 a.m. and it goes up all the way to the end of the trading day. And this return, or this essentially gain, is sustained in the second and also the third day. But the majority of this run-up really happened on the first day, on the day prior to the announcement of the refunding plans. So the difference is really striking if you really compare this pre-TRA day return, cumulative return at the end of the day versus all of the other days. Basically, on all the other days, the market barely moved on average. So it's kind of like very close to zero. But on the days when the TRA is about to happen, so on the day before the TRA, we typically have around 12 to 13 basis point increase in the prices of the 10-year bonds. And this magnitude is even higher if we look at some long-dated bonds. For example, the 30-year bonds, this daily run-up can be as high as 23 to 24 basis point. So that's, in a nutshell, is what we find in this paper as very striking pre-announcement drift, not in the equities market, in the treasuries market, not with regard to other macro announcement people typically look at, but specifically related to the Treasury's quarterly refunding announcements. And this thing, as we have essentially tried to establish in the paper, is very robust. It's not really related to which day is this a pre-announcement day. And also, it's not exactly related to the fact that a lot of these pre-announcements happened towards the end of the month. So if we control for the fixed effect of those things, we still have a pretty salient and a pretty significant pre-announcement drift.
Yeah. I read this in the paper. So when I was reading the paper, I mean, there was one question that I had in my mind, and I wanted to ask you, and it's that the drift is really significant, and it's in the data. Now the question is, there are other market participants, and they are sophisticated, and then a lot of the time, I mean, when there are like factors and strategies, they have a problem with liquidity, etc. But here we have a drift in one of the most liquid markets in the world. Now we are going into the speculation and theory and hypothesis, etc. Why do you think that there is such strong drift, even that there are a lot of market participants that can move a lot of the money? And I mean, it's not arbitrage. So that's like my question.
I can start. So the leading theory that we currently have right now is that there's a reduction of uncertainty that happens on the Treasury refunding announcements. So we test this in a couple of different ways. The first way is looking at changes in the MOVE index in the week prior to these Treasury refunding announcements. So the MOVE index, if you're not familiar, is kind of like the equivalent of the VIX for Treasuries. So it's a measure of volatility calculated through options. And so what we find is that when there's a large change in the MOVE index in the week prior to the TRA, so this is when like there's a lot of uncertainty around treasuries, around the TRAs, these are the times where pre-TRA day ends up having the largest. Basically, the takeaway is that when there's a large run-up of uncertainty prior to the TRAs, there's a large reduction of uncertainty on the TRA day, which results in this higher drift. That's one piece of evidence that we have. And the second piece of evidence along this line is one of the unique quirks of the TRA is that the Treasury's Office of Debt Management holds meetings with primary dealers in the days leading up to the Treasury refunding announcements. We hand collect these primary dealer meeting days from the Treasury website, and then we're able to see the days where these primary dealer meeting starts line up with this pre-TRA day. And then what we find is that when the start of the primary dealer meeting lines up with the pre-TRA day, these are the times when the drift is the strongest. So what we hypothesize is that there's some information exchange that might happen in these meetings with the primary dealers that leads to a reduction of uncertainty during the pre-TRA day.
Okay. It makes a lot of sense.
I get out of this, which maybe some of the viewers might be a little confused by. It's a different kind of market than most people are used to thinking about, and there's not that as much free flow of information, or there isn't supposed to be as much as in, say, the stock market, because the primary dealers have special access, right? And they'll be hedging before the announcement and maybe unwinding hedges, and they might have information that other participants don't have that maybe will be reflected in the repo market or in asset swaps or some other more complicated data. Have you thought about that? Because that could be a huge effect, right? The primary dealers have a lot of influence specifically at this time in the cycle.
Yeah, I'm glad you pointed out the structure of this market is very different from the equities market, for example. So by and large, the treasuries market is an over-the-counter market, and the primary dealers, we talk about Goldman Sachs, Morgan Stanley, all these large banks, they literally make the market for the treasuries. So not only they are kind of kind of market makers and major players, but also they themselves hold a lot of this in their own inventories, which means whatever they do will have an outsized impact on the market. So there has been a lot of study in the finance or in asset pricing that talks about basically from the financial friction side or financial intermediary side, like if they have more constraint, they will require higher compensation from this market. So that leads us back to this question of why, if they know there's such a drift, why wouldn't they do anything about it? So the short answer to this question is the fact that there is on average positive drift doesn't necessarily mean that going into this meeting, you will always have a positive return. So you can basically take advantage of this ahead of time, ahead of others. So large part of this really is related to what Kevin just introduced. It's really related to the fact that people are literally talking to each other. Then the market as a whole was paying a lot more attention, and also a lot more essentially uncertainty is resolved through essentially a lot more trading on these days, which we have evidence, and also through basically the meeting of these the primary dealers. On average, so sometimes you have positive news, sometimes you have negative news. On average, maybe the news part cancels out. So what really drives this upward trajectory is this reduction of uncertainty. Think about the second moment. So the reduction of the second moment is what really drives this positive drift on average. But this doesn't mean that going into the meeting, they know it's going to be a positive drift. So they still have to think more about the first moment when they're essentially decide their strategy every time around this TRAs.
As far as we know, this is the first paper that documents this effect in the academic literature. I don't know if it's well known or not in the practitioner space. So it could just be that practitioners aren't aware that this is a possible strategy with a very high Sharpe ratio, right? And like, for example, with something like the pre-FOMC drift in the equities markets, like at least when the seminal paper in the academic space came out, like the effect was extremely strong up until that point. Like since then, the effect has actually died down a bit. So that could be some evidence that some people are trading that away after the discovery, right? So like as far as we know, this is at least in the academic space, the first paper that documents this drift. So it might just not be well known at this point.
What you said makes a lot of sense. If it's risk premia, right, it makes sense that people will demand more money because of uncertainty, especially if they have an obligation to hold inventory or they have exposure to inventory they might hold, right? So that makes a great deal of sense. And the idea that it can't be arbitraged away because it's just pure risk is compelling. Have you tried to condition it on maybe some evidence of surprise, like the quality of the auction, the tail, or maybe research from banks prior to and compare them to the actual numbers?
Yeah, thank you for pointing this out. This is something we have thought about. I think, when Kevin and I first look at this very striking pattern of upward trajectory, I think the first thing we said to ourselves is, can we just borrow some of the common explanations people have for the FOMC and pre-FOMC announcement drifts to explain what we have at hand. So perhaps maybe one of the leading explanations from FOMC to explain the FOMC announcement drift is that there might be some leakage of the monetary policy news. So a lot of that maybe has been communicated between some of the Fed officials and the market, so the market kind of know that, so they can trade accordingly on the day before the actual announcement. So the first thing we wanted to know is that can something similar to the leakage story happen here? I think I like your suggestion of looking at exactly what the bank says, what the researcher says on the street, and do they have collectively any more information. But the first thing we look at is to link this pattern to what exactly the Treasury announces. So the Treasury, as we know, they make announcements not only of a magical number of how much they're going to issue for the next 3 months, but also they issue a lot of other things. Among them is their marketable borrowing needs. And not only their announcing this marketable borrowing needs for this upcoming quarter, which is basically the official announcement, but they're also making their own estimate of what we're going to do, not in an immediate quarter, but the next quarter. So which allows us to compute what we call a forecast revision from the Treasury's perspective of how much they're going to need. So if you think about the forecast revision, this really is kind of the new information to the Treasury. So they thought we're going to do, let's say, $100 billion in Q2, but after the quarter, maybe they have some new information, they will revise the number. So the forecast revision really captures kind of the news to the Treasuries. So we specifically look at three variables here. The first is their announcement for the current quarter. So this is basically the announcement for what they're going to do in an immediate quarter. And also we look at their previous announcement. So essentially their announcement in the previous quarter. And lastly, we look at their news component. That's what is the forecast revision of their own marketable borrowing forecast. So we look at basically three series. And the first one, you can think of this as the actual announcement. This is the lagged actual announcement. And the last one is really the news to their borrowing estimates. So we kind of regress this onto the pre-TRA returns, basically the one-day return that we have single out. And the finding really is there's basically nothing here. So this one-day return on average, which is positive, this positive one-day return doesn't seem to have any meaningful relationship with the current announcement, the lagged announcement, and also the revision in their estimates. So by and large, it's probably telling us there's no basically systematic leakage. I think that's something maybe we can say for sure. But also it means that the upward trajectory, this pre-announcement drift, probably is not really related to what's actually announced. It's more related to, I think at least this is more in line with what Kevin and I have found or preferred, which is a reduction in the uncertainty of essentially the supply of the treasuries.
Yeah, and that would go to the surprise factor, right? It's adaptive expectations. It's not what they announced, but what they announced compared to what people thought they would announce.
Exactly. So, but I like your idea. So maybe we can also look at what the private sector says about what's their forecast and what do they think the treasury is going to issue, and to use that as essentially a benchmark to compute this surprise factor. So that may lead to some fruitful findings, but this is something we're working on, and hopefully we have more to share in the future version of the paper.
Yeah, this is already far beyond most other submissions that we saw. It's not only great in that it's very specific, which I love, but it's also very sophisticated and thoughtful and thorough, which is something a lot of these kinds of papers lack, but obviously not in your circles. You yourselves are very sophisticated, but it's the kind of thing we really like to see.
Yeah. I really have to congratulate you guys, because I must say that your paper was really one of the most favorite papers among the judges. That's the reason why you won, but I mean, you won by the significant margin. So that's what I can say. I would like to thank you guys very much, and we wish you all the best in your future professional life. It's a job well done. So thank you, guys.
Yeah, thank you very much. Yeah, we're very honored. And thank you, and also thanks to all the sponsors of this award.
Yeah, thank you.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.